Welcome everyone to our Investing for Women webinar. We're often approached by women who find the investment conversation mysterious or challenging, so we wanted to create a safe space to talk about some of the most frequently asked questions we get around investing. And we want to help women gain confidence in their financial journeys. I am so thrilled to have this very bright panel with me, three of my esteemed colleagues. And I'm Carol Jakovich. I'm a senior financial advisor with our Everyday Steward division. I've been here 24 years, and I have myself found that women really crave talking about investments. It's not something that they usually talk about it, but it's something they want to know more about. So I'm super excited to be able to have this conversation. Grace, can you tell me a little bit about your background and tell everyone here what you've been doing around investments?
Yeah, absolutely. Well, I'm thrilled to be here. After a number of years of working in the secular workplace, it has been just a joy to get to be here at Ron Blue serving clients. And the biggest differentiator, what initially drew me to the profession, was the ability to help people. But getting to do that from the platform that we have at Blue Trust, to do it from a biblical perspective, has just been so life-giving. And so that's what's brought me here and how I work with folks. And women have been a wonderful group of clients that I've gotten the privilege of working with across the wealth spectrum and in different seasons of life, from single, married, divorced, widowed. So it's been a sweet journey to get to walk alongside women in all areas of their financial life, but specifically investments as well.
I love it. We're so glad to have you here, Grace.
Thank you.
Sherry, you've been here with us for a while. Can you tell me a little bit more about your journey?
I actually started my career in public accounting. So
Okay.
That was a little bit different, but it's been about 13 years as an auditor. And I loved switching to doing financial planning investing because now people talk to me because they want to talk to me.
Right.
And it's really exciting and rewarding. And especially, as Grace mentioned, just that opportunity to talk with people at all stages of life and make sure that they have the information they need from the biblical perspective, especially to make wise decisions with their finances. So I really enjoy that part of it.
Awesome. We've been so glad to have you here. And Mary Helen from the land of awesome queso in Texas. Tell us a little bit more about you.
Yes, excited to be here. My name is Mary Helen Klingen. I'm a senior financial planner out of our Houston, Texas office. I have a background similar to Sherry. Started my career as a CPA in public accounting, also did a little bit of corporate accounting too. And it's been really neat to transition into financial planning and advising and helping clients make good decisions with their finances. And when I specifically think about investments, I remember when I worked in accounting, just thinking that investing was this really overwhelming concept, and I really struggled with confidence around it, and found myself and so many other women kind of sitting on the sidelines. And I remember thinking to myself kind of right before I jumped into financial planning that I really wanted to get my arms around investing, and if I could, I really wanted to help other people get their arms around investing and really make wise decisions. And is there an easy way to understand this? Is there an easy way to make good decisions? Or do you have to be an investment expert and do this, day in and day out to make good decisions? And thankfully, the answer is yes. There's a simple way to understand it. And so it's really been a joy for myself to grow in that knowledge, and then also get to help clients make good decisions and think through this area that can be really nebulous, confusing, hazy, and kind of clear some of those cobwebs. So I'm really excited to talk about the topic we have today.
Yeah, I just want to interject. Having flashbacks to my first days at accounting, as she mentioned, I remember you come out, you think you know everything, degree in accounting, pass the CPA exam, and they hand you this packet from HR with all this stuff about the 401k, and it's not anything that you've learned to that point. So that's really driven my passion as I'm in this field now. I'm thankful I got to come here because now you can help people, as you mentioned, get rid of the mystery, because it can be so overwhelming and so intimidating when you look at it, and it's not part of, you think you should know, but there's nothing that teaches you about it ahead of time.
That's
so
right. And my parents didn't
Your
tell
parents-
me
it's not
about
dinner table
it.
conversation
I had
at
the
all.
same
So-
experience. I agree.
that's what I love about this group is we get to share some of that information so other women can feel equipped to make those decisions.
Yes, absolutely. Well, Grace, you and I, before this, we were talking about some really interesting statistics, and I was wondering if you could share a few of those.
Yeah, absolutely. Reading the statistics and looking, and similar to your story, Sherry, we do see just a huge need around this area of women and investments, and it's reflected in a lot of these numbers. 14% of women say that they know a lot about saving and investing. 33% feel confident in their ability to make investment decisions. 19% of women feel confident selecting investments that align with their goals. And 65% of women say they'd be more likely to invest or invest more if they had clear steps to do so. And that's
Wow.
part of the purpose of this call today, and to talk through what are the next clear steps that women can take in their investments.
Right. Oh, thank you for sharing
Yeah,
that. Yeah, we
absolutely.
hope we'll get those numbers a lot higher, that women will feel very comfortable looking at their investments after this. Okay, well, let's get into it. You know, when I think of investing, I think there's kind of two primary ways I can earn money on my money. And one is ownership and one is lending. So Sherry, can you tell me a little bit more about those two things?
Yeah, I'd be glad to. And I love that you break it down into really two fundamental things. I think that takes a lot of mystery out of it. So regardless of the investment or how complicated or complex it may seem, it really boils down to one of those two things. You either own or you lend. Owning is simply what we think about. We own property, we own jewelry, we own cars. You know, we know what it's like to put our money into something that we own with the idea that it brings some sort of value to us. And some of the ladies out there may even own a business right now, you know, on their own or with someone else. And when we're talking about investing, we're talking about owning a company much like you would just a small business that you have. You're just one of many, many owners instead of just being on your own. And the beauty of that is if you do need to sell it, it's a lot easier than it would be if you're trying to sell your ownership of your own business or your partnership, a smaller pool to choose from. But when we're talking about investing in stocks, which is the term, when we're talking about ownership, stocks or equities, it's the same thing that we're talking about there. In that scenario, we have the stock market that we all hear about, which is nothing more than a place where you can go and take what you own and sell it to someone else, or you can buy from someone else. It's like a big farmer's market, but for companies. So we get to do that. And there's two ways that you can make money when you own. And the first is, again, just like your own business, if you make a profit, there's something that comes back to you. Companies are the same way, even if they're as large as Exxon or one of the other companies out there. If they do well, they may share some of those profits with their owners. Now, some of the profits they put back into the business to continue to grow and move forward, but they do pay some of those profits out to the owners, and that's what's called a dividend. So I've owned a company. I may collect a dividend every quarter or once a year, which is really my share of the profits of this company that I've invested in. The other way that you can make money owning is, you know, you buy this great company and you feel like it's really going to do something down the road. They've got this great idea, this great project, and I really feel like this is going to be valuable several years from now. So I buy it, and let's say I buy it for $10 a share. Fast forward 5 years, and now it's worth $30 a share. So I can sell it to someone else for that higher price, and I've made money just through the value growth in that particular company. So I can either share in the profits, or I can hold on to it and sell it later for more than I paid for it. Now loaning, which is the other thing you mentioned, is a little bit different. Now instead of, let's use Exxon for example, instead of owning part of Exxon, I'm actually going to loan my money to Exxon, which sounds kind of strange. We're used to taking money as a loan, not giving it. Or if we're loaning to the neighbor down the street, we may or may not get it back. Fortunately, the goal in loaning in an investing standpoint is that you're going to get that money back, but you make money along the way through the interest that they pay you. So and when we're talking about what we call those loans, if we go to the bank and loan them money, which may sound really strange, but that's actually what a CD is. You're loaning your money to the bank. They're going to pay you some interest, and they're going to use that money for other things. And then when that CD matures, you can get your money back. If we loan to the government, we're going to call that a treasury or a note. It's the same principle. We're going to give them money. They're going to pay us interest, and then when it matures, we get the original amount back. If we loan to a corporation like Exxon or any other big company out there, we're going to call that a bond.
Okay.
So our fixed income, that's the other terminology that we throw out there. So if we own, it's a stock. If we loan, it's a bond. And again, we make money periodically. With the bond, it's the interest that they pay you for borrowing your money. And then it's not as much as with the stocks that you're going to get growth in the value and sell it for more later, but there is the potential that the bond value, if you need to sell it before it matures and you collect the principal back, you might make some more money that way as well. Now, I think we're probably going to talk about risk and reward, but there are some risks even with those loans, just
yes.
You're concerned about getting them paid back. But it's really every investment out there, you're either owning something and sharing in the profits, or you're loaning and collecting interest because they're paying you to use the money.
Thank
just
you.
very simple
That's
principles
so
there.
helpful, really, to boil it down to those two things, either owning or lending. And it kind of boils down to stocks owning
Right.
and bonds and fixed income
right.
on the lending.
Yes.
That helps a lot. Okay. So what about, you kind of touched on it, but there is some risk with investments. You know, I think about if I leave my money at the bank, there's usually not any risk, but I'm not going to make as much. So if I want to take some risk and participate in one of these other types of investments, I'm going to expect, hopefully, some greater return for my risk. So Mary Helen, can you tell me a little bit more about that and the relationship between the risk and the return?
Yeah, absolutely. So I'm here to report basically that every investment that we take has some risk, unfortunately. But it always helps to start with reality.
Yeah. And you know what? There's risk in not doing anything as well, right? And that's a key concept. If we do nothing, we're just going to fall behind inflation and fall behind our goals if we do nothing. So that's a risk as well.
Yes. So even sitting in cash has its risks.
Right.
And I know as women, we want to be very safe with our money. You know, we're typically very security mindset. And so I think this area of investing can be really overwhelming because the risks are just out there and
right.
you know, anything that can go wrong. And so cash may feel safe in some moments, but that might not make sense for every area of our financial picture. But what I'm reminded of often is that in the back half of the book of John, Jesus reminds his disciples before he goes to the cross, he keeps telling them, peace be with you, peace be with you, I'm with you to the end of the age. He keeps repeating these themes because he knows this world is not perfect. We're going to experience challenges which are going to create risks for our investments. And in fact, unfortunately, the Bible kind of promises us that things are going to be complex and are not necessarily going to get any simpler. And that's going to affect how we think about investing. And so there's some specific risks with investing that could be specific to a business, to a country, to a specific type of region or area. So this might look like a risk to a specific business. Maybe you're investing in travel businesses that are operating around travel and leisure and entertainment. And if a recession comes and a lot of people lose their jobs, that may be the first thing that's cut in their spending. And so that business might not do as well.
Or if a worldwide pandemic happens,
Maybe.
something like
Something
that.
like
yes,
that.
we get it.
Whereas we always need our groceries and our food
Right.
and things like that. And then there are just some general market risks that are inherent to investing. And I say this all the time to my clients. Unfortunately, the future is just uncertain. That dadgum future is just always uncertain.
Right.
And so there's going to be risks associated with that we are unavoidable. And so the bottom line is that every investment comes with some type of risk. And so that looks different for stocks versus bonds, like Sherry mentioned. They come with different risks and they come with different rewards. And so owning a stock, the risk of that is that that company could not do very well, like I talked about with that travel business during a recession. It could stop paying out dividends. So a lot of people think that, you know, their dividend investment is safe and is always going to happen. But if that company runs into a period of underperformance, they also may cut that dividend. And so that piece of your return may not happen like you think. And then with a bond, when you lend money to a company, that company could not do well and not be able to make that interest payment back to you. And generally, owning a bond is less risky than owning a stock. And that's because if a company hits, say, you know, the worst situation of bankruptcy and they, you know, need to kind of shut down business, those bondholders are going to be first in line to get their money back versus a stockholder. Because when you're the owner of the business, you kind of take the whole risk on yourself, and we're gonna talk about reward, but also you're kind of last in line as that business owner to get your money back. And so that's why bonds are a little bit more of a conservative, less aggressive investment than stocks because they have less risk.
Yes. And so generally speaking, just, you know, correct me if I'm wrong, we would expect a lower return on bonds in general because there's less risk than we would on stocks in the long run because you're taking more risk, you get more return.
Exactly. So the flip side is that the reward of owning a stock, when things go well, you're going to participate in that, and your upside could be, you know, as high as the value of the company goes. But bonds, you're limited to, your return is just that return of interest because you've just lent them your money. They're going to pay you that interest. The bond might go up a little bit in value if you sell it before it matures, but exactly the same thing that it's going to do better. And so we see this relationship play out, and I think this chart is really helpful just for women to see overall the bottom line. We've talked a little bit about cash, and so you can see cash is the least amount of risk, but least amount of reward. Bonds are in the middle, and then stocks are on that high end. And as we think about cash specifically, this is where what we've talked about, it feels the safest. You know, if women come to me and say, just how do I keep my money safe? I'll just keep it in cash. The risk with cash that most people don't think about is that long-term inflation, which inflation is just the cost of things going up year by year. And so your $100 a week grocery bill next year turns into $110, you know, 5 years from now, $150. But if you've just sat in cash, your $10,000 that's sitting in cash is just going to be $10,000, you know, in a few years. But the cost of things are going up, and so the risk of cash can be something that maybe we don't think about, and we really need to think about where that makes sense. Now, cash is integral to every piece of our not every piece, but cash is integral to the health of a financial plan. I can't show up with my stocks or my bonds to my local grocery store, but we have to really think through where cash makes sense for the different pieces of our financial plan, because it's got that risk component that sometimes we
and I
forget
think
about.
in a little bit we're going to get into that, which is really important. But thank you. That really helps us kind of frame out what risk versus return looks like. So, Grace, let's talk about all the terminology that's out there. There's lots of it. There's mutual funds, there's exchange traded funds, also called ETFs, there's custodians, there's just all these terms. I'd love for you to cover a little bit more.
Yeah, I'd be happy to. Well, we have lots of terms in this profession, and we also
sure
have a lot of
do.
acronyms. And
Yes,
it can be
we
hard
do.
to keep up with them. So I'd love to run through a couple of the most common that you'll likely hear when you're looking at your investments.
Great.
You mentioned the first one, custodian. That's just simply the financial institution that holds your money. So you can go to one, and just like there are a lot of different grocery stores, there's Wegmans, there's Harris Teeter or Kroger, depending on where you live in the country. There's a bunch of different options, but a lot of them do pretty much the same thing, just a little bit different feel to them. That's how it is with a lot of these financial institutions. So Fidelity, you might have heard of, or Charles Schwab. They're different custodians that you could open an account and hold your investments in. And so that's what a custodian is. Another area that I often see confusion around with clients are the different account types. There's a lot of different names and a lot of different rules around them. What can be helpful to think about it is if you put them in two different buckets, non-retirement accounts and retirement accounts. And in the retirement account bucket, those would be the accounts like your Roth IRA or traditional IRA, at work if you have a 401k or 403b plan. All of those accounts have rules around how much you can put in, when you can take money out.
Yeah.
It has unique tax treatment for all the different actions that you're doing with those accounts, and they all can only be held in one person's name. So those are all for long-term savings. That is what retirement accounts typically are focused on. Non-retirement accounts, or they're often called brokerage accounts, are also accounts that you can invest in and you can save for the long term, but they typically have less tax rules around putting money in or out.
Yes.
The tax consequences come in a brokerage account when you're doing trades within those.
Right.
And they can also be held jointly with a spouse or someone else as well. So those are some of the differences between those two different types of accounts and the broader buckets you could put them in.
Great.
And then the last item you mentioned was mutual funds and exchange traded funds. And those are simply, you can think of it like a basket of stocks or bonds, like Sherry had just shared, where instead of buying a bunch of different stocks, you can purchase one share of a mutual fund or an exchange traded fund and diversify your investments, meaning you're holding all the stocks that are held within that basket. And it's a way to, as I mentioned, diversify, and the fund manager is responsible for buying and selling the different stocks within the fund, and you're just participating in that as a shareholder of that particular fund.
Awesome. I love that. And I love that grocery store analogy. I use that a lot, so I think it does get confusing. Let's say there's a mutual fund XYZ and a mutual fund ABC, and trying to understand where can you buy it. Well, you can usually buy it at any of the grocery stores, if you will. You can buy the same one at Fidelity and Schwab and Merrill Lynch, and that's just the grocery store, where you buy it. And so I think that helps make it a little bit easier to see, okay, how do these all work together, the stocks and the mutual funds, and how they interact with the custodians. So thank you so much for that. All right, well, now let's talk a little bit about kind of what's unique to Blue Trust, integrating the biblical principles into the investing. I know that the Bible actually has a lot to say about this. So Sherry, tell me one of your favorite Bible verses that has to do with investing.
Yeah, it's really funny because almost all the investing principles, when you go back, they have a biblical foundation. Everybody doesn't always realize that, but they do.
Yeah.
And the one I want to share is from Ecclesiastes, and this is probably one of the first things anyone hears talking to any advisor, but they don't realize the biblical foundation. So Ecclesiastes 11, 1 and 2 says, "Cast thy bread upon the waters, for thou shalt find it after many days. Give a portion to 7 and also to 8, for thou knowest not what evil shall be on the earth." And what this is talking about is a term that we call diversification. And like it says, you just don't know what's coming.
Right.
We don't know what's going to happen tomorrow. We don't know what's going to happen next year. We don't really know what's going to happen with the economy. So it makes sense to spread things out to 7 or 8 or more. And there's a couple of variations of diversification. The first is in companies and sales. So you mentioned the mutual funds. That's a great way to diversify, because you don't want the one company, Tamir Helen was talking about risk. If that company goes under, if all of your investments were in that one company, then you'd be left with nothing.
Right.
Whereas if you've spread it out, even if that one company just hits on hard times and doesn't make it, you've still got investments in other things to help keep your portfolio alive and moving forward. The other way to diversify is not just with the mutual funds or certain companies, but it's also kinds of companies. We have a slide, we call it the Callan chart. To me, this chart makes me think of being in chemistry class back in high school.
Yeah.
It looks
it's
like
the periodic table.
It is. It's the periodic table of elements,
yes.
exactly. And I love looking at this, and you don't even have to be able to read what's in each box. All you have to know is that every color represents a different kind of company, maybe big companies, small companies, foreign companies, commodities, just all the different things that you can invest in. And what this is showing you is year by year which one outperformed. So whichever color's at the top one year, that means they were the best performer that year. And our inclination often is, well, we'll just see what did well last year, and that's what we want to invest in. But if you look at this chart, sometimes what's at the top ends up at the bottom within the next couple of years. So you can get in a lot of trouble going back. So what I tell clients all the time when we pull this chart up is that, what can you tell from this chart? that you can tell nothing from this chart.
Right.
There is absolutely no rhyme or reason to what is at the top or what's at the bottom.
Right.
Because we don't know. And that's the scriptural principle there is, if you want to manage the risk that we've talked about already with that reward, diversification is really a key part of that, and that you spread things out. And I actually like the first part of the verse as well, where it says, after, they say, thou shalt find it after many days. It makes me think of patience. Because sometimes we want to have everything be at the top right away. But investing is a longer term scenario, and we have to be patient sometimes to let those different pieces work together to get the return that we're going for. So I think the diversification is just a fundamental principle.
It is. It's so
really
fundamental. And I have a real quick example from a client experience, and it may help ladies that are listening that work in a really large company. I had a client come in 1999, and she worked for Delta, and all of her 401k was in Delta stock. And I walked her through this principle, and it said, we really would not recommend that. We would really recommend that you diversify well. And she said, but everybody that I work with, everybody has everything in Delta stock because, hey, we're Delta. We've always done well. It's always done well. Why would you not do that? I said, I don't know. Except that the Bible tells us to diversify, and we have to be humble enough to say, I don't know what's going to happen. So she diversified. Lo and behold, 9/11 happened, which nobody could predict. Right. Nobody could predict how that would impact the airlines industry. Nobody could predict Delta would go bankrupt after that. Mm-hmm. And all of her friends were looking at her like, how did you know to do that? Mm-hmm. So I just thought that was a powerful story
that's very powerful.
Of why we diversify. Mm-hmm. So Mary Helen, tell me about your favorite biblical principle when it comes to investing.
Yeah, so Sherry alluded to this. I love the principle of having a long-term perspective. Mm-hmm. And really, we know as believers, we have the ultimate long-term perspective of we're looking to eternity, forever with the Lord. Yes. But we can also implement that on this side of heaven as we're walking out our stewardship journey. And I think this principle is exemplified well in the story of Joseph in Genesis, where Pharaoh comes to him and he's got to interpret this dream, and there's going to be 7 years of harvest, of plentiful. And then there's going to be 7 years of famine.
Right.
And so Joseph is put in charge to navigate his country through a 14-year economic cycle that some of it's going to be good, some of it's going to be bad. And so we see Joseph have this long-term perspective and be able to lead his people through that time. And we see it over and over again in different parts of the Bible. But when I think about having a long-term perspective, I think about two ways that we can do that. First, we can kind of zoom out and get the big picture, because sometimes we're focused on our tiny little, time and space. And I love this chart that we have that we see the stock market all the way back to 1926 to now. That's 100 years. And if
okay, that's crazy.
Yeah.
Yes, okay, move on. But yeah,
if someone would have invested $1 in 1926, which this is pre the stock market crash of 1929, Great Depression, a lot of difficulty, they would have over $14,000 today.
Wow.
And if we look at this chart, there's a lot of drama in the world over the last 100 years. We've got World War II, we've got JFK being assassinated, Cold War, inflation of the 70s. You pick a decade and time, space, there was something dramatic going on.
Right.
But what we see is that, yes, there are these little, or not little, but there are these up and down movements of the market in the short term. But over the long term, it has that trajectory up and to the right if we just zoom out. Now, if we start zooming in, we can, be on this ride of up and down, up and down. Mm-hmm. And so that perspective really helps us kind of take a step back and realize what we're dealing with. Yes. And that even though maybe it can be scary in the moment, one thing that people remember recently is COVID. And if we look at that chart, it's a teeny tiny little blip. I bet for all of y'all, you would probably say, I don't necessarily know that was a blip on my radar.
It did not feel like a blip at the time, but yeah.
But it's a blip when we
Right.
zoom out.
Right.
And so we can zoom out and get that perspective that can really help us focus on the long term and not get caught up in the short term ups and downs.
Yes.
And the second thing we can do to have that long term perspective is we can plan and prepare. And this is what we saw with Joseph in Genesis, is he got a plan in place. And now I'm a good Houstonian, and I know every now and again in Houston, there's going to be these things that show up called hurricanes, these
Yes.
storms. And I know, because I've seen it time and time again, that the best time to get my food and my water and all my supplies is not necessarily when the eye of the storm is, right over my city, but I need to do that ahead of time.
Right.
It's the exact same thing with investing, because we know there are going to be these storms. We know that there are going to be things that happen in the world. Sherry just told us about this. The Bible promises us that there's going to be disaster somewhere.
Right.
And so the way that we plan and prepare is we ask ourselves the question, when do I need my money back? That's the only, almost the only question you need to answer when you are thinking about investing. And so there's kind of three main time frames I think about, technically four, but there's kind of short-term money. So the next 1 to 2 years, maybe you want to buy a car or a house. And then there's the intermediate term time frame, so kind of 3 to 9 years out. So maybe you've got a kid going to college in a few years that you're saving for. And then there's that 10 plus year or even 20 plus year time horizon that's very far out in the future. So maybe that's retirement for someone. And when we think about those time horizons, we don't invest the same way for each of those time horizons. So if I know I have, a home remodel or a car purchase or something in the next 1 to 2 years, I'm going to invest a little bit more conservatively with that piece of my portfolio. I might have cash, money market, short-term bonds, because really my risk in the short term is what I just talked about, that up and down volatility, because I know I don't have time for it to recover. And then for the intermediate term piece of the portfolio, for those expenses, I have a little bit more time, but not a ton. So I can get a little bit more aggressive with my money. So maybe I can invest in something like intermediate term bonds. And then the long-term money is kind of where it gets a little bit fun, because we know we've sectioned it off. We don't need that money for 10, 20, 30 years. So we've got time on our side, which is a really great thing to have on your side.
Right.
And so I can invest a little bit more aggressively with that piece of the portfolio. So that's where you can start layering in stocks, US stocks, international stocks. And this is where kind of the secret sauce is in some senses, because when there's some sort of crisis, stress, drama in the markets, typically the piece of the portfolio that's going to absorb the most of that, that's going to be impacted, is that long-term bucket. COVID was another great example of this. Not great, but helpful example.
Yeah, helpful, yes.
In the sense that, when COVID first showed up on the scene in March of 2020, the stock market was down 30% in a matter of a few weeks. I mean, that's a significant piece to be down.
Right.
But for a lot of our clients, it was a non-event because they had planned and prepared, and they had that short-term bucket and they had that intermediate-term bucket. And what happened in COVID was actually those were up or stable in some sense. So it was kind of business as normal from a financial investing perspective, even though from a human and all of those things was maybe not normal. And so it's just really neat when I've gotten to explain this concept to clients, because they're just thinking, well, you've told me all the risk and you told me everything that go wrong. I mean, what in the world? I mean, do I just sit in cash like we talked about? But you think about the time frame of when you're going to need your money, and you allocate that appropriately, so you have that time with the long-term money that's really aggressive for it to recover. A lot of people think about the 08-09 crisis. That's another thing that people think about. If you were invested during that time when the stock market was cut in half, your money came back in about 2 years.
Right.
But if you're thinking about things from a time-based perspective, you don't need that money for 10 more years. That's a long, long time, and most of the time even more. One stat that I share with clients is the US stock market has never had a down 15-year period. Now, they've definitely had down years, down months, down days, but if we extend that time horizon, things get a lot more smoother. And so that's really the way that we help clients navigate through and have that plan and have their proverbial water and food and things and their metaphorical hurricane that we know is going to come in investing.
Yes.
So it's...
Thank you for reviewing that. I mean, that is absolutely foundational to our investment philosophy and how I've seen clients thrive. I mean, they thrive because this is how we manage the risk, and it really takes so much of the risk out of their investment policy statement if we manage it this way.
Yeah, and it's so neat
you.
to start the conversation with clients a lot of times who are on the precipice of retirement. You know, that's a big, scary kind of change of what's this going to look like, and to see them kind of take a deep breath and get to a point of peace of mind and clarity, and I know what the plan is in place. It's just really neat to see clients move to that spot walking through this.
Yes, thank you, Mary Helen. All right, Grace, do you have a favorite biblical principle driving investments?
Yes, I do. And it is avoid get-rich-quick schemes. And in thinking about that principle, I am reminded, and I'm probably alone in this, but I do not like to wait for anything.
You're not alone. Okay, maybe not alone.
No, so maybe not alone, but I don't like to wait for things. I definitely need to work on patience in a lot of different areas of my life, but I think the area of our money can be very similar with our health. I think can be a good analogy. If somebody could offer a fitness plan and a weight loss program where I could do it in 2 weeks and lose 20 pounds and get a six-pack, I would sign up. We all want the quick fixes, and we want it just to be easy, whether that be in our physical health, but also in our money. And so one of the very first steps that I walk clients through when they start working with us is to start with getting back to the basics. It's again, like health. We know what do we need to do to get healthy? Eat better and move our bodies, right? And in our money lives, it really can be simplified down to what do I need to be doing today that is going to support these long-term goals? And if one of my long-term goals is to invest, I want to start growing my money. I want to be able to be financially independent one day. I want to give more. I want to send my kids to college. Getting our goals aligned in such a way that we make sure our house is taken care of first. And so prioritizing things like making sure we have enough cash on hand for emergencies or short-term expenses that might be coming down the pike, and keeping that cash in a high-yield savings account can be a great place to do that. And then looking at, have we paid off debt? Other than maybe something like a mortgage, do we have high-interest debt on our balance sheets that we really want to get rid of? And so any extra cash flow that we have, let's allocate it towards paying off debt. And then then we are freed up to move towards our midterm goals, which maybe those are the things like Mary Helen shared about a car, or maybe that's a home down payment that we know is in the midterm that we want to be planning for, that we also need to be setting a cash aside for. And then once we get to that point, we're freed up to allocate some of our cash towards investments, towards these long-term goals that we've been talking about here today of getting our money working for us in a portfolio, but making sure that our house is in order. And that just takes time, and that's okay. And oftentimes, the steps that we are making towards building wealth, it's slow, but a great quote around building wealth is spending less than you earn for a long period of time. And we see that with clients who are just faithfully doing the next thing, doing the next right thing when it comes to their cash flow, saving, and then eventually getting to investments. So,
wonderful. That's super helpful. Thank you.
Absolutely.
Gosh, thank you all for all these great words of wisdom, tips, insights, definitions of certain terms on investing. I think it was really helpful. Thanks so much for joining us. Grace was mentioning some statistics at the beginning, and one last statistic we found is that 86% of women feel less stressed if they have a financial professional helping them with their investments. So if we can help you in any way, please reach out to us at connect@bluetrust.com. We would love for you to join us for our last webinar that will be streaming next Wednesday, March 27th at 2 p.m. Eastern Standard Time. You can scan the QR code on your screen to register for the next one.